Hello and welcome to Business Incorporated live on Channel Television. Well, it's the trading day right here, the Thursday trading day right here in Lagos, Nigeria. And we're going to be looking at a lot of things today. Oil production in Africa and the global monthly report from OPEC. We're going to be dissecting what's played out in that report, looking at Nigeria's oil production actually dipping in February compared to January. Well, so much to unpack today, but let's get to what's playing out in the global oil market. Now, we're seeing oil prices, they're largely steady today after surging in the previous session with that larger than expected draw in U.S. gasoline stocks there as markets are weighing macroeconomic headwinds so far. So we're seeing Brent trying to hold on above that $70 per barrel level, $71.12 a barrel. Then we're seeing U.S. WTI, that's trading at $67.81 a barrel, trying to get back to that $70 psychological level. We'll see if that happens at some point. Let's get a check on the metals market now. Gold prices edge higher as uncertainty over tariffs that persisted, driving safe haven demand, while a cooler than expected U.S. inflation print that also supported bullion, by strengthening expectations of rate cuts. Spot gold that was up 0.4%, $2,943 per ounce. While the U.S. gold futures that firmed up 0.2% at $2,951 per ounce. All right, so other stories now. It's all about most of the stocks trading in Nigeria and their dividends announcement. Geregu Power PLC declared a final dividends of 8 naira 50 kobo per ordinary share for the financial year ending December 31st, 2024, marking an increase from the 8 naira per share distributed to stake shareholders in the previous year. This declaration was outlined in a corporate action, and that was shared with most of these platforms. Now, shareholders whose names appear on the company's register as of the close of business on March 13th, 2025, that's today, will be eligible to receive the final dividend. And the African Development Bank and the International Institute for Tropical Agriculture have signed a $27 million deal to finance the second phase of a program tagged Technologies for African Agricultural Transformation. The Director General for the Nigerian office at the bank, Mr. Abdul Kamara, explains that the program will serve as a catalyst for the productivity of smallholder farmers to meet the bank's Feed Africa goals. A total of $40 million was earlier earmarked for the first phase of the project, bringing the total to $67 million for both the first and the second phase. Take a listen.
Officials from the International Institute for Tropical Agriculture are meeting their colleagues from the African Development Bank to seal a deal that will boost food security in Africa. The representative of the IITA shares perspectives of the benefits to farmers and the federal government's plan for improved food production.
We will work together to accelerate technology deployment to ensure that climate-smart innovations are accessible to farmers where they are needed most. Strengthen partnerships between research institutions, governments, the private sector, and development organizations to create sustainable agricultural value chains.
According to the partners, some of the successes of the first phase of the program: improved varieties, increased yields and income for farmers, enhanced crop resistance to pest and climate change, and mechanization.
Extension and youth training.
The partners are hoping to double the successes of the first phase.
Ministries of Agriculture and the private sector that will continue to play a vital role in transforming agricultural practices and ensuring food security across the continent. Of course, we already have seen early results. The wheat value chain in Ethiopia, for example, is a classical case where in 2017, we supported that country with only 60,000 metric tons of heat-tolerant wheat varieties.
The partners then put pen to paper to seal the deal. The pact is expected to enhance food production.
You're done.
This week, just yesterday, the Organization of Petroleum Exporting Countries, OPEC, released its monthly oil market report showing Nigeria's oil production that dipped in February to 1.46 million barrels per day, about 70,000 barrels less than the 1.53 million barrels per day reported in January. Let's talk to Chinan Dikwa now, as the Vice Chair, African Energy Council. Great to have you on the show, Chinan. It's been a while.
Ladi, it really has. Yeah, pleasure to be here. How are you?
I'm fine. Well, so it's that time we've been waiting for. Yeah, we have the monthly report from OPEC. So how are you seeing the latest oil production report? I'm looking at it from the African continent and, global production in February.
Yeah, so Ladi, I think there's not much of a story here for this month. And the reality of it is it's exactly what you described there. Last month, the numbers were about 1.5 million barrels per day. This month is dipped slightly by 5% to 1.46. So it's not a massive story, I don't think, because, very, very much you could say it's stayed flat. In fact, the number we're seeing right now is exactly what we saw in about January of this year, which was about 1.48. So it stayed relatively flat. I think the fundamental thing here that people can take away is the fact that we have seen a huge increase in oil production in the last 18 months. If you go back to January of 2022, about 1.1 million barrels of oil production. Today, we are 30% higher than that. In fact, we're producing at our OPEC quota, and I think that's the biggest thing here. So we have been able to meet that. So it's a huge kudos to government in terms of what they've done. The question is, what's the next frontier? Where do we go from here? I think that's the big question. The forecasts are that we'll get to about 2 million barrels. Whether that's possible is for us to wait and see for end of this year.
What do you think, looking at the data there, we're seeing 1.46 million barrels production. That's for February compared to 1.53. What do you think is responsible for Nigeria's production, dipping, slightly though, even though it's slightly, but it's still a dip? What do you think is responsible for that?
Ladi, honestly, that is well within the margin of error. It's a 5% drop. That could be anything. That could be operational maintenance. That could be anything. It's very much well within, the margin of error. So I wouldn't focus on that at all. I think the fundamental question to ask is, we forecast that oil will be at 2 million barrels per day by the end of this year. The question is, how do we get there? What new fields are going to come up? What workover and interventions are going to give us that 500,000 barrels per day extra? That is the fundamental question. And when I look in the horizon, in the short term, honestly, I don't see it as yet. There are glimmers of hope, I'm going to say. There are glimmers of hope, particularly around small independents. Most of the new production that we're having. So just for context, actually, Ladi. January 2022, we're 1.1 million barrels. Today, we're about 1.5, roughly. A lot of that increase has not even been the super majors. A lot of that increase has come from small independents, the Hears Holding, the Seplats, those small companies. And I think that's where the success story is. Nigeria has been able to pull off on the expertise of large majors, Shell, Chevron, Exxon, all of that, and pass it into these small companies. And they are getting more barrels out of those fields that they bought. That is the big story. So the question is, we're seeking 500,000 barrels. Is that going to come from these small independents? That is what will be very exciting. Because if it does come from them, that means we've learned a lot. We can take that into Angola. We can take it into Namibia. We can start to BBC basin around Senegal. So, export of services and genetics, basically.
Right, and we still see the top producers in Africa. There's still Nigeria, Libya, and Algeria. But this is a critical time where the Dangote refinery and other refineries need feedstock to produce petroleum products. But we're getting reports that Dangote refinery is eyeing more, crude from Angola and Algeria, while the Naira for crude deal is still in limbo at this time.
Yeah, so I think, let's bear in mind, that in the space where we are, there's a lot of information coming out. So 2 days ago, we got a report that the Naira to crude deal was being suspended. The NNPC has already come out and dispelled that. They said, it's just under negotiation. And it is true that the deal was meant to expire in March. So I think that makes sense. But to your point there, Ladi, bear in mind the capacity of Dangote refinery is 650,000 barrels per day. Okay, if you look at what happened in October of 2024, where the Federal Executive Committee came up with an order to say that the NNPC had to sell a huge portion of its production to Dangote. I think at the time was something like 385,000 barrels. In total, 450. So including other small refineries. But Dangote would get about 385,000. Operationalizing that and making sure he got that 385 has been a problem. He's gotten a huge chunk of it. I think so far to date, the NNPC confirmed that they gave him about 48 million barrels of crude so far. And that's great. But the reality of it is it needs 650,000 barrels per day. And that is where the delta is. This man has put huge money down, and he has to operate at capacity for him to be able to finance the debt and maximize production from these facilities. So what you're seeing there, to your point, is he has to look, to the US to pull off some WTI. He has to look at Angola, where you described that. He has to look at Algeria to try to see if he can source the crude from there. But would that be easy? Honestly, I don't think it will. I know some of the crude has already landed, and he's using that. I think it's a very short-term mechanism. I don't see how this could work longer term. The reason for that is even when you go to Angola, Angola has huge contracts with China. Most of their crudes are going to China. They don't sell a lot on the open market. So I think Dangote would have to be inventive to find crude elsewhere. I do not see that as the long-term alternative.
All right, it's one thing, to source your feedstock from other countries, even though we're in an oil-producing country right here in Nigeria. So if this continues, the Dangote refinery having to source from, other African countries and, WTI, as you mentioned, how does this, translate when it comes to petroleum product pricing in Nigeria? Should we just expect, higher prices, or we might still see this battle there, this price war continue taking prices lower?
Absolutely. That's a very smart question, Laddie. So a couple of things to bear in mind. If Dangote keeps doing that and keeps buying crude on the open market, a few things would happen. There will be, first of all, a pressure on our FX because he has to source all of that in dollars. And to source all of that in dollars, he has to find it from Nigeria. So there will be pressures on our FX, so our currency will get devalued in a very short term. In fact, just for context, let me just say this. Before the Naira for crude deal, just the FX costs on subsidy buying of external, petrol products to bring in was responsible for about 30% of the value of our currency. So just FYI. So that pressure has been taken off right now, which is why you can see that the Naira has picked up strength over the last couple of months. If that's to happen again and he starts to go out onto the international market, then expect to see volatility, FX volatility. That's number one. But number two, and more important, the crude oil that would hit the pumps in Kano and Abuja and Lagos and Calabar and all of that would be much more expensive. The reason for that is just the FX movement and all of the costs, because if you think about the freight, if you're bringing from the US all the way here, all those freight costs and everything would have to be built into the cost that will be passed on to the consumer. So fundamentally, from that standpoint, yes, we would expect that price to go up. And of course, Laddie, this, if price goes up, then ultimately inflation will start to creep up, because the price of almost anything in Nigeria is denominated by cost of transportation. So there is another part there, which is inflation that could also start to creep up. So I think there are several dimensions. It's so important that Dangote is locked into that Naira for crude deal. From a national standpoint, it works for us. There's an impact on foreign exchange. There's an impact on inflation. There's an impact on jobs and a variety of other areas.
All right, and definitely we know Trump did talk about, wanting oil prices lower, going forward in 2025. We talked about the drill, baby drill mantra, but we're seeing oil prices actually tend lower, at this time with WTI losing that $70 per barrel psychological level. Is it downhill from here? Is it time to just pull up all the shorts for oil?
Yeah, so that's it. We also have our forecast at the African Energy Council, but I'll say a lot of the forecasts that you see outside, so you go Bloomberg, any of these companies, They see oil for this year at an average around the $74, $75 mark. Today we're around 70, okay, but generally around 74, 75. And the reason for that is several-fold. Yes, Donald Trump has come, and he's talking about drill, baby, drill. What does that mean? He wants the US to increase oil production in a very big way, not just oil, even gas as well. But if we stay with oil, think about this. Today, the US is the highest oil producer. They produce about 13 million barrels of oil today already, 13 million barrels. He wants them to increase that. The thesis that we have is when they increase that production, there's approximately about 2 million barrels that will come onto the market, oversupply. With that oversupply, the price of crude oil will come down significantly. There's no question about that. And if that happens, then I think, for a state like Nigeria, we need to start to think very cleverly around what to do. What's the price point for our budget? How do we peg to make sure that we're still, very competitive? What's for market share and all of that? But without a doubt, I think we should brace in for a period of volatility in the short to medium term. I think there will be quite a lot of turbulence. The other dimension, Ladi, is the tariffs. And I think that has even more of an impact, actually. You've probably seen this. There are lots of talk of the US potentially going to recession, parts of it going to recession. Now, if that starts to happen, the global economy would take a shock. And with that, ultimately, people will stop spending money, stop traveling. Demand for crude oil will also plummet. So now we're talking supply. So think about this. If they put 2 million barrels onto the market, that's an oversupply situation. If a recession comes, that would destroy demand. So all of a sudden, you have a double whammy situation. And that is what I think could be the game changer for 2025. So smart, oil traders are already hedging their bets. Smart governments are forecasting, their budget in a very, very sensible way. And I hope we're doing the same.
Right. Time to get, sensible at this point. It's quite incredible how the tariffs just come on and go off or paused. A lot to look out for in 2025. That was Chinandekwa, Vice Chair, African Energy Council. It was great having your perspective today. Thank you so much.
Thank you. Pleasure, Rodney. Thank you.
All right, we'll take a break now. When we come back, we head straight to the markets, find out how your money is performing. That's in a moment. Just stay with us. All right, let's find out what's playing out with the markets. For the local bourse, we're still in positive territory year to date and quarter to date at this point. But the month to date, not looking so good. But Will has the details, and she's wearing red.
Oh, Ladi, why did you put me on the spot there?
Yeah.
No, you didn't have to do that.
You know how the red color impacts traders?
No, the red color in Chinese culture means blessings. They're good things. So you think of it in a positive light for today, just for today.
So you're blessing portfolios.
Yes.
Even though you're wearing red.
Even though I'm wearing red.
Fantastic.
So let's check in on major stocks now. We track in Africa at intraday. Equities were mostly in the green. Nigeria's NGX was marginally up at intraday, 0.04%. The GSE in South Africa, we see it positive at intraday, 0.26%. And let's look at EGX 30 in Egypt and see how that performed at intraday. It was up 0.75%. If we look at that on the screen, we see also Kenya's stock market closing Wednesday's session in the red. Well, before we dig deeper into the NGX, let's see what's happening in the Middle East. Let's see the stock market in the Middle East. We see Saudi Arabia, we see Dubai. Let's start with Dubai. Dubai was up 0.46%. And we see Abu Dhabi also up 0.08%. This trading is at intraday. Let's check out Saudi and Qatari indexes. You see the Tadawul in Saudi Arabia 0.12% up. But however, Qatari index is trading down 0.46%. Let's check out what's happening now at the NGX. We want to know if what's happening was pulling markets, was moving the market at the moment. And we have Ambrose Omodian, Chief Research Officer, Invest Data Consulting, joining us virtually. Good afternoon, Ambrose. It's good to have you on the program. Let's hit it while it's hot, Ambrose. What stocks are investors making a move on at intraday? Ambrose is not here with us now, but let's just move quickly and see what's happening in other markets. We see U.S. stock futures were a little changed in pre-market trading. That's, after that, S&P rose 0.5% in volatile trading. We're also seeing the Dow futures edging up 0.03% in pre-market trading. On the other hand, we see S&P and NASDAQ futures. They were in the flat territory, negative territory in pre-market trading. Now, February's consumer price index showed inflation rising 0.2%, month-on-month at 2.8%. That's below expectations and also eased investors' concerns. Now, the softer inflation reading helped to calm fears over economic direction and potential price shocks. Meanwhile, trade tensions escalated as Trump's steel and aluminum tariffs took effect. And that prompted Canada to retaliate with a 25% levy on $20 billion worth of U.S. goods. Now let's see Asia markets now. It fell on Thursday despite a soft U.S. inflation report that helped Wall Street recover from losses. U.S. inflation, as I mentioned earlier, rose 0.2% in February, bringing the annual rate to 2.8%. Analysts say the latest figures easing concerns over price shocks, but caution that Federal Reserve may still remain vigilant. So no rate cuts in the horizon, maybe. Now in Japan, the Nikkei 225 closed in the red, while we see South Korea also in the red. It's red market for Asian stocks here, especially maybe they didn't react so positively to that soft inflation data from the US. The Hang Seng in China is also down 0.58%, and mainland China's index, that's the Shanghai index, also closed negative 0.39% down, and the Nifty 50, Nifty 50 stocks, the Indian stocks are in focus, and that comes after the country's inflation, that was data we got yesterday, cooled to 3.61% in February, and that raised hopes for stronger economic growth. However, the Nifty 50 closed today in red territory, 0.33% down. So I don't know if Ambrose is back on there for us to have the conversation. But Ladi, just speaking about what's happening at the NGX, we see a lot of caution, especially investors are now, they're a bit picky right now. It's like you did talk about cherry picking, but it's more like go in and stay in, but they're not doing that. You see a lot of profit taking happening, especially now that we have Dangote has brought up the 13 naira dividend. We see all the dividends come on board, but
all the dividend announcements,
announcements coming up, but investors still aren't taking the bites. There's like waiting. I don't know, maybe waiting for the banking sector, because we see at intraday banking stocks, just as such as FCMB, First Holdco.
First Holdco. We need to get used to that one.
We need to get used to that one. That was a mouthful for me for the first time. And there was a Zenith Bank and Fidelity Bank. Those stocks were doing so well. Jay's Bank also doing well intraday. I'm thinking, are they taking position for the, earnings, the audited financials
because
coming up?
We're going to be hearing from the banks very
pretty soon. Yes, much later. But we're hoping there will be no delays, especially with the earnings, especially since it's the audited financials. But investors are a bit, worried that they might be lower.
Maybe it's because of where
the
all-share index, is, at this time. It's still near, all-time highs at this point. And, definitely some investors will be, watching, trying to find out when that major pullback is going to take place, would actually happen, because no market goes up forever. So some investors might be looking out for that, and maybe just also gauging what's playing out with the economy. So far, if you're reading what's happening with some of the results, we're still seeing cost of sales.
It's high.
It's still high. It's still high. So it's still high. Doing business.
Yeah.
At this point. So I guess there's a lot to look out for. We're still seeing data coming out. We're looking out for the data, inflation data. That's for February. We're seeing the developed economies still looking quite strong.
And inflation cooling in most parts of the world. But we're hoping that we did get that 10% drop in January, but we don't know if it's just as a result of the rebasing of the data.
Definitely
what will happen in February. But with the lower fuel prices, the chance that we're having now, we might be seeing lower inflation data, especially now that food inflation is not taking the bulk of the basket at the moment. So we have transport, other services coming on board there, and fighting that battle with food in the food basket. So we're hoping to see, but food prices still remain elevated. But we're hoping that, it trickles down, because you're seeing lower fuel prices, but it's not trickling down. Let's just bring it down to the everyday living right now. We don't see in the public transportation, prices are not coming down. Soon, it's not reflecting. Yes, it's very sticky. It's not reflecting right now. So food prices might stay elevated for longer. So what is the government, where they come in right now to check and ensure that the lower prices we're experiencing, we're seeing at the pump, will also go down to the actual transportation.
I guess that's where consumer protection
comes in. And these people,
at some point.
The companies as well, because if they have to pay a higher price for transport, cost of sales remain elevated, and then investors might not make a lot of profit because profit remains smaller, and the profit declared, the net profits remain smaller, and then investors are hoping, we're going to get for dividends?
What are you going to get?
What when get
profit is not coming in as expected? But definitely a lot to look out for. We'll keep tracking. PPI, that should be out sometime today.
For the US market.
The US market, definitely that should, give investors some kind of direction.
Especially most of our, trade is denominated in the dollars. We've not changed. We've not moved away from that yet. So we want to see if that comes lower. It's still be good for Africa and other markets that are still dependent on the dollar.
Right. All right. At some point, we'll try and get Modion again. Maybe he couldn't join. We'll try and get him.
I hope the markets didn't give him the jitters. That's holding back.
Maybe he's busy trading.
Well,
thank you so much, Will, for giving us the details of what's playing out with most of those markets that we track at this point. All right, let's get a check on all the stories now. We see British Petroleum Company aiming to increase gas production in Egypt by about 160 million cubic feet per day from 2 wells in the King, Marit and Fayoum concession areas with the deep waters of the Mediterranean Sea. And that's for the second half of 2025. So all eyes on Egypt at this point. Will the gas production actually increase, in 2025? All right, to other conversations now. We're looking at global commodities. Global wheat prices are expected to rise in the second quarter of 2025 due to adverse weather and reduced supply. Nigeria has experienced a drop in the price of wheat flour. This divergence in price movements that raises questions about the factors influencing both the global and local markets. Furthermore, despite the fall in wheat flour prices, the cost of bread that has remained stable, and the impact of global tariff changes on wheat imports could have implications for inflation in Nigeria. Let's discuss more now with Ajibola Ayodeji, analyst with Financial Derivatives Company. Great to have you on the show. All right, we'll try and get Ajibola on to tell us what's happening with those wheat prices. We're seeing a forecast. We're seeing a forecast there that wheat prices might actually go higher in 2025. That's coming from the IU. But let's get another what's playing out on the African continent now. We see industry leaders, experts, and key stakeholders from across the trade ecosystem are convening in Cape Town, South Africa, for the Africa Trade Conference. Organizers say the gathering aims to bring together influential voices to shape the future of trade on the continent, driving innovation, sustainability, strategic partnerships, and inclusive growth. This year's conference is themed Empowering Africa Through Trade, Innovation, and Sustainable Growth. Our South Africa correspondent, Innocent Somoza, has more.
The conversation here focuses on innovative trade solutions, sustainable practices, and strategies to expand markets. Stakeholders across Africa's trade ecosystem acknowledge the numerous challenges facing intra-African trade, including inadequate trade policies, logistical bottlenecks, and protectionism, among others. During the conference, Mark Obion, Counselor for Economic Research and Statistics at the World Trade Organization, shared his insights on unlocking Africa's trade potential in the global market. As discussions around the Africa Continental Free Trade Area gain momentum, the key question remains: how crucial are partnerships and collaboration in unlocking Africa's trade potential to ensure inclusive growth that benefits all sectors of society?
I think it's at the heart of what we are talking about, because for trade to get the level we are looking at, there's regulation involved. And therefore, for you to make that happen, you need to partner government, you need to partner DFIs, you need to partner logistics company, so all of the value chain, that relates to trade. So very, very, and that's why if you look at this conference today, we brought people who do logistics, private sector, DFI, so that we can have a conversation as to how we can partner.
As private sector, what type of policy initiatives do you expect from government in making sure that we indeed unlock trade in the continent?
All right, so if you look at the challenges that we face with trade in Africa, it's a couple of things. The first is around the lack of productive capacity in Africa. So what we do today is that we take cocoa, we take cobalt, we send them abroad and we get refined goods. We don't have productive capacity. How do we create an environment and financing to be able to actually take cocoa and make chocolates in Ghana or Cote d'Ivoire?
The executive head of strategy and investment, Access Bank South Africa, Yinka Yomi Tokosi, emphasized that Africa must drive discussions on policies and initiatives that empower women and youth in Africa's trade sector.
Okay, so that's a very good question. So obviously, as you know, Africa is a population of about 1.5 billion people. However, we only represent 3% of global trade. So that means that there's a lot of opportunity for us to unlock. And a significant population of the continent is actually young people. So ideally for us to grow that is how do we ensure that we empower young people, and trade is a way.
Dominique Fojo from Anglo Ashanti echoes similar sentiments, highlighting the importance of inclusive trade policies. As stakeholders continue these critical discussions, the challenge remains in translating dialogues into action, ensuring that trade growth is inclusive, resilient, and benefits all Africans. From Cape Town, South Africa, Innocent Samosa, Channels Television News.
Thanks, Innocent. Well, let's get back to the global commodities that we track now, starting with wheat. We're talking wheat today. Let's get back Jibola Ayodeji now. She's an analyst with Financial Derivatives Company. Great to have you on the show.
Thank you. Good afternoon.
So we see there's a discrepancy between local and global wheat price movements. I guess, if it's going down, locally, consumers will be happy about that. But why are we seeing that discrepancy?
All right, thank you. I would like to lay a context before I answer that question. First thing is that wheat is an imported commodity, and about 95% of the wheat that is consumed in Nigeria is imported. So I'd like to say that between December and now, we have seen a stability in Naira. So, and because wheat is an imported commodity, it provides like an incentive to reduce import costs for people that are producing, for producers. Another thing, and one of the major things I would like to mention that contributed to this decline in the price of wheat is the fall in the price of fuel. We saw that beginning at the early December last year, 2024, we saw that the price of fuel was going, PMS now was going at 1,065 naira, but now it is down to 860, which is like a 19% drop in the price of fuel. So this contributed to the decline because we saw that most of the manufacturing firms in Nigeria, energy cost is one of the major things that is used, and logistic cost. So a decline in the price of fuel really bring down the price, their operational cost. And if there is a decline in operational cost, it really impacts the goods produced, in which wheat is part of it.
Right, I remember I've had some bread producers, on our shows, and they complain about not able to, sell bread, at affordable prices because of, inputs, getting expensive. So why hasn't the drop in wheat flour prices, why is that not reflected in bread prices? Instead, we're seeing, stability at this point with bread prices.
Okay, firstly, you must know that it is not only wheat flour that is used in producing bread. There are other ingredients that goes into the production of bread. We have sugar, you have butter, and some other things that are going. So if there's no corresponding decrease in the prices of this other commodity, we might not see, it might not reflect in the price of bread. That's one. Another thing is that when there is a decrease in the input cost, it might not really have an immediate impact on the price of the product. So the businesses or the producers of bread are looking at it. Maybe they are waiting if the reduction will be sustained before making some adjustment in the price of bread. That's another thing. Then another thing is that they might be because of the loss that they have recorded in the past, this might be a recovery period for them, and it might be like a building themselves towards maybe future fluctuation that may occur in the price of wheat flour and some other ingredient that is used in flour. So this might be the reason why maybe the price of bread have stayed flat for now. But
Right.
if the price is sustained, if the decline in the price of wheat flour is sustained for a long period of time, maybe we'll be seeing changes in the price of bread.
Yeah, we definitely need those prices to come down right here in Nigeria. That's talking about bread. But, we still have those tariff jitters rocking global economies at this point. How could the 25% U.S. tariff on wheat imports, how could that affect global prices and inflation in Nigeria, especially for wheat-dependent staples?
Okay, I would say it might not really affect Nigeria. The reason why I'm saying is that if there's Trump is imposing tariff on imported commodity into the US, and if there's a retaliatory measure from these other countries, especially their major trading partners, there might be a reduction in the demand for wheat in the demand for wheat in America or from all these other major countries. They might source for wheat in other places aside from the US. And if this occurs, there will be a surplus in the US stockpile. And if there's a surplus in the US stockpile, it might bring down the price for countries like Nigeria that are neutral, they are not in trade war or anything. So it might bring down the price of wheat for countries like Nigeria that import commodity. So if there's a decline in the price of wheat for us, I think it's a plus for Nigeria because it will bring down the price of other products.
Right. I'll definitely love to report lower prices at some point in 2025 and going forward. But thank you so much. Jibola Ayodeji is an analyst with Financial Derivatives Company. Thank you.
Thanks for having me. Thank you.
All right, let's take it on to Europe now. Let's get a check on what's playing out there. The European Commission President Ursula von der Leyen said that the billions in defense loans planned should be spent on weapons made on the continent. Well, join us for more now and on what this actually means. We have DW correspondent Chiponda Chimbelu in Berlin. Great to have you, Chip.
Thanks for having me, Ladi.
So can you unpack the plans, for the U.S. right now? I guess most countries, all they're thinking about is what to do next. With most of these tariff wars we're seeing right now, they're planning on their next move at the moment.
Well, when it comes to defense plans, the European Commission President Ursula von der Leyen said that she wants the investments in defense to have what she called positive spillovers for the EU economy. So von der Leyen wants to see the 150 billion euros of new funding for defense spent on European-made weapons rather than arms imported from the United States. And she was making that pitch in the EU Parliament in Strasbourg, where she addressed EU lawmakers this week. Now, von der Leyen also said that the funds should be used to boost the bloc's defense industry. Ensuring the investments stay here and benefit the EU would, of course, also help put some mojo back into the European economy, which has been struggling. And to be implemented, the plan needs a majority backing in the EU Parliament. So that's at least 55% of the member states, representing just under 2/3 of the EU's population, Ladi.
And I guess this is good, if you invest most of that money into companies in Europe. I guess that's a plus for Europe.
Well, theoretically, of course, and I mean, in a sense, it is, because, of course, European defense companies have been benefiting on the stock markets. Rheinmetall's stock has pretty much doubled since last year. So, of course, it's welcome news for EU companies, but it's worth considering that the United States is the biggest supplier of arms to NATO countries in Europe, and from 2020 to 2024, it accounted for 2/3 of arms imports to the continent, according to research by the Stockholm International Peace Research Institute. Now, that is, of course, significantly higher than the 5-year period before then. So European countries have actually been buying more American weapons in recent years. So limiting spending of any EU loans on weapons and arms made in Europe will also mean that the capabilities of made in Europe weapons may be limited. The United States can produce far more sophisticated defense systems, and it will take the Europeans some time to be able to produce similar arms. Now, because Europe has traditionally relied on the United States, it hasn't really developed its own defense industry to the extent of where the U.S. defense industry is. So Europe does have its work cut out, and that is the point, because of course the United States is the global leader when it comes to making defense. And one expert we spoke with told DW that the European Union and European countries are very dependent on the U.S. when it comes to some infrastructure. So closing that gap will be, of course, a significant challenge for Europe going forward.
Right. I guess these are challenges when you have over-dependence, at this point. All right, turning to the markets now. How are European stocks trading today?
Well, European shares were up earlier, but they're now shedding those earlier gains, and they're actually down after the prospect of a 30-day ceasefire for the war in Ukraine has been, of course, thwarted by Russia, and that's just happened in about just over an hour. And the pan-European stock 600 is actually down 0.2%, and Germany's DAX now is down 0.95% after trading higher as well in the morning. But of course, we should mention that European stocks are faring better than American ones, where the S&P 500 is down 5% since the beginning of the year. European shares, of course, have been benefiting from government plans to increase their spending on defense. But there's, of course, still a lot of concern about tariffs and uncertainty that they would bring. And just moments ago, we had news that U.S. President Trump is threatening 200% tariffs on European wine and alcoholic products. So there's of course more to talk about. We'll have to find out what happens next in the coming hours. But there's more tariffs being threatened on the EU today from Donald Trump.
Well, I guess it's a wait and see at this point. But thank you so much, Chip, for bringing us up to speed on what's playing out in Europe.
Thanks, Ladi.
All right, now let's get a check on what's happening in the world of crypto. Now, we've seen that bounce yesterday. I guess that's playing into the market today. Looking at Coin 360, we're seeing it's mostly green on the screen with pockets of red. Maybe a recovery is coming in this space at this point. But I'm sure investors are still quite wary right now. Let's get a check on how they're feeling. Talking about the fear greed index. How investors, are they greedy at this point, or it's fear? So I guess that's an improvement from extreme fear. The market was investors in the market were extremely afraid recently, but now we've seen an improvement there, and it's fear. That's, I guess, even though it's still, it's quite negative, but it's fear. It's better than extreme fear. All right, let's get some top stories now in the market. We see Binance, they've received a $2 billion investment from a company called MGX. They're an investment firm linked to the Abu Dhabi government. That the crypto exchange's official release there celebrated the firm's substantial footprint in the UAE and getting that big boost there with investment, showing that they're welcome in that country. Now we see Grayscale, they're accumulating more Cardano. That's ADA, Grayscale Investments, a leading digital asset management firm, recently intensified its focus on Cardano, that's a cryptocurrency. This heightened interest in evidence through their substantial accumulation of ADA tokens and their strategic move to file for a spot Cardano exchange-traded fund. That's an ETF with the U.S. Securities and Exchange Commission. So I guess that's some bullish news right there for Cardano. Then we also have some data coming out for crypto exchanges. We see in February, crypto volumes declined about 20.6% to $7.20 trillion. That's for the volume traded on most of the cryptocurrency exchanges like Binance that we track there. Then we see CME Bitcoin futures that declined about 20.3% as the basis hits about 4.08%. CME reached record 4.67%. That's for derivatives market share. That's some data out from CoinDesk there on what's playing out with most of the crypto exchanges. So we're seeing declining volume. I guess that's on the back of the sell-offs we've seen with the crypto market so far. All right, so our next conversation now, we're seeing in today's fast-evolving digital world, the financial landscape is transforming at an unprecedented pace. The rise of digital payment system, reshaping how businesses and individuals interact, especially across Africa, where access to reliable financial services has been quite a challenge. With new technologies like APIs, that's application programming interfaces, and widgets, playing a pivotal role in simplifying payment solutions. These innovations are bridging gaps and enhancing business opportunities in the region. Well, let's dive deeper now into this conversation. We'll explore how digital payments have evolved in Nigeria and across Africa, importance of APIs and widgets in improving financial access. Joining us to discuss this, we have Ogochukwu Umeokafor. She's Director of Product and Management at Yellow Card. Great to have you on the show.
Yeah, great to be here. Thank you.
So talk to me about how, digital payment systems, developed in Nigeria and across, the African continent. How they're looking, to you right now.
Yeah, actually, it's very interesting to see how digital payments has evolved over the past years in Nigeria and Africa as a whole. Basically, at Yellow Card, what we basically do is to ensure that we are able to be the frontier and to foster digital payments through the use of stable coins. So basically, I know you talked earlier about APIs and the rest of them. What we have done is to ensure that we empower businesses and individuals to be able to make payments across borders. A typical example is, scenarios of businesses, global businesses not being able to make international payments, not being able to have the payment rails within Africa. Basically, through our APIs, we enable them to be able to foster these payments, to enable them collect payments from their customers within the continent, and do business, real business within the continent. So, in truth, right, I will say basically stable coins is revolutionizing how payments move across the continent. And we've seen a big level of adoption when it comes to Africa, and especially even in Nigeria, to speak.
Right, I'm talking about APIs and widgets. We see there are terms that people, hear about, but they don't fully understand what it is. Could you break down what they are and why they're crucial, for businesses in Africa?
Yeah, so APIs, like you mentioned, is an application programming interface. But what essentially it does is we give you the ability to integrate into us, into our payment rails, into our collections rails through the use of the application programming interface. So we're not giving you a user interface or an application, but we're empowering you with sets of APIs to integrate into us. So what this means for businesses essentially is your business can keep running as usual. Your customers don't even know that behind the scenes, the payments that are being made are powered by another entity. All they see is you, for instance. Say the name of my business is Ogo and Sons, for instance, and Ogo and Sons has integrated into our APIs, okay? Basically, every customer of Ogo & Sons does not know there's a powerhouse behind the scenes powering all the payments within Africa. That's basically what that does. So essentially, if I'm a global business that doesn't have footprints in Africa, by integrating into our one API, we enable you to be able to have coverage across the 20 African countries where we're present at. So that's a big win. It's a typical example where we see startups that don't really basically know, how to get into certain countries they want to do business at. And then we see a lot of them reaching out to us and saying, hey, how can we do this with you guys? How can we collaborate with you guys? And the API is the single source of truth for that, right? Because we have done the legwork, of having those payment rails in these countries, gone through all the regulatory requirements there is, and then we're kind of an enabler for businesses to be able to thrive within Africa in these countries where we have, where we operate in.
Right, and how do you think, a business, how do you think they should make that decision, when it comes to choosing an API and a widget, platform, something that, maybe might be more innovative than, what's out there?
I think it basically depends on the level the business is at. So the API, right, side of things is you would have had to have done some level of KYC for your customer. You would have implemented some level of regulatory framework or KYC and AML checks within your business. if you want to use our APIs, because what we make sure we do, we make sure we keep up with the standard global practices around, being compliant with regulations, being compliant with FATF, and, all the regulatory bodies around, financial services and what we basically do. So if you want to use our API, we verify and make sure that for your customers, you've done KYC for your customers, so you can facilitate payments through our API rails. But there are also certain businesses, right, that, they're still very much new. They don't have the manpower. They don't have what it takes to have done KYC and, gone through the various level of checks and transaction monitoring. So we offer them the widget, which basically enables. So what that basically does is when you integrate into the widget product, we carry out KYC for the customer. We do all the checks, the transaction monitoring, the fraud checks for you and all. So it's another service, right, for those customers that don't have those businesses that don't have the ability to do that or haven't implemented that framework within their organization. So basically, it plays in two different ways depending on what you want. So we basically positioned ourselves for different markets, different businesses, but essentially one global vision, which is we enable you orchestrate payments within. We are the payment orchestrators. We enable you, we enable your businesses to operate within Africa by providing you with either our APIs or with our widgets.
Right, and APIs, and widgets, they sound, really cool, if you're, listening to this. But are there any risks to, using, APIs and most of these widgets for payments?
No, I don't see any risk there should be for businesses, as long as if you are using our API, you're doing what you have told us you should do on your own side. So what essentially means is that you have carried out the due KYC on your customers. What it means is that you're monitoring the transaction trends. What it means is that you're ensuring that the transactions that are going through our rails are the right transactions. They're not, there's no form of illicit sort of payments going through. I don't see any risk there is. What we do is to just make sure that we enablers. We are basically enablers or payment orchestrators, as it were, enabling you to be able to do businesses within the countries where ordinarily you don't have the manpower and you don't have the ability to be able to make payments in those countries.
Right, and we see most businesses, trying to get into that digital space at this point, selling digitally. But many small businesses, they face challenges with, payment integration. How are these technological solutions, helping them remain competitive, in that digital economy?
So for small businesses, again, it's still what we've seen. In fact, it's very funny because I have a very clear case where recently someone was reaching out to me. The person launched a fintech and said, "Hey, Yellow Card, I know you guys are able to enable me collect payments within Africa or make payments into Africa. Can I use your APIs?" So basically what this is doing for small businesses is enabling businesses scale. So for some businesses, they have footprints in one country, but they don't have in 90 other countries, or they have in one country and they don't have in 10 other countries, right? What we basically would do is to enable those small businesses to have a reach in these countries where ordinarily they won't be able to have reached on themselves or would have taken them years to reach. So within our business, right, our core focus is what exactly do we need to do to enable businesses and payments within Africa in the countries where we operate in. So be it small businesses, be it big businesses, we work with both small and big businesses, depending on your value proposition, depending on what you want from us or what you want out of, the countries where we operate in. We have different models that we basically pitch to you and explain to you how we work. So out of the variety of product suites we have on the B2B side, you're able to pick out what suits your business most, and then we help you orchestrate those payments and facilitate those payments into those rails.
Right, it's all about payments. Once you're doing business, you want to be able to receive, money for your goods or services. Well, thank you so much for breaking it down for us, how the APIs are helping. Ogochukwu Umeokafor, Director of Product Management at Yellow Card. Thank you for coming on today.
Thank you so much. Yeah, take care. Bye-bye.
All right, so that's how most of the markets we track are looking today. We're still seeing positive sentiment in most of the continents that we track. Bitcoin, Ethereum, all of the cryptocurrencies bouncing at this point. But will this continue? That is the question. Watch again tomorrow and you'll find out. My name is Ladi Williams from here, the team, right here at Channels HQ. It's bye for now.